Welcome to Mad About Money. Today we're going to talk about what's happening on global financial markets. We'll discuss what's going on with Clive Palmer. We'll hear about Blackmores, Bellamy's and the banks, and we'll learn about what you need to be across in regards to the budget and the possible changes to super. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money. We've only got 2 minutes and we're going to cover each topic in no more than 2 minutes. First topic, Paul, global financial markets. Good night in the US last night. Nice to see some green on the screens. Your thoughts on what's happening at the moment?
Well, it's all about oil and earnings season. The earnings season in the US is just kicking off, so it's too early to see how that pans out. I should also just give an apology for Peter. Apparently he's not here today, so...
Yeah, we don't know where he is, but he decided he didn't want to turn up.
He decided to look...
Which is a rarity for him.
It is a rarity for him, but let's get off that. Look, yeah, I mean, the US market looks strong again. I think, obviously, big expectations about the Doha meeting on the weekend. I can't work out why...
The Doha meeting is where all the main players in OPEC are going to get together and they're going to work out whether or not they're going to cut supply.
Yeah, with some non-OPEC members as well, as I understand it. I can't work out why, if oil goes up, it's good for the US market, but it is, so maybe that it's just beyond me, but we keep talking about that. But that's for the expectation at the moment, oil back at some new highs.
Because oil going down should be good for all businesses except energy businesses.
It should be, but it's a perverse world out there at the moment. I think there must be massive short positions.
It's uncommon sense.
It's uncommon sense. That's what I like markets.
Yeah.
But coming back to the US, I think more importantly for the US is really about earnings season. It's just in the first couple of days of that. It's really important how that pans out.
We've had our Alcoa report so far. They were a bit off.
Yeah, look, a couple are a bit below, but really early days. The expectations are low, and I think we've got to see that. That really picks up speed again, starts to pick up speed next week. So let's see how the earnings season plays out in the US. That's really important, I think.
And top line growth is what I guess the market will be looking for in terms of the US. Because bottom line, I think people think we can grow earnings by cutting costs, but people want to see growth via revenue.
They want to see growth in sales, and of course, with the US dollar having been so strong, they're concerned in particular around a lot of the US multinationals, weak Europe. What's that meant for their top-line sales growth? So really important numbers. Expectations are very low, so that's a positive. But
good day in our market yesterday, but it's been a tough sort of few weeks. Your thoughts on what's happening there?
I still think we're a bit range-bound. I can't get excited about our market simply because it seems to fall away on nothing. We're going to get. Obviously a good day today. But interesting enough, we went through this on the program on Monday on Switzer TV, that what the problem with our market has been the top 20 stocks. They're about more than 50% of our index. They are totally lagging the market this year. That's because no one wants to own the banks. No one wants to own the BHPs and Rios. No one wants to own the Woodsides. And people didn't want Woolworths or Wesfarmers. Now, the last day and maybe again today, the top 20 is sort of on the way back up. We're going to see obviously some enthusiasm today for banks. We're going to see good news for some of the energy companies. BHP and Rio will do well today. So the top 20 is going to lead the market up. It really needs to come back into the forefront to take this market higher. So if this is more, if this just proves out to be a bit of a correction in this downward trend, who knows? But I think we've got to see the top 20 type stocks. We want to see the fund managers put more money back into the top end of town. If they start to do that, then you can get some strength in our market.
Moving on, next topic, Clive Palmer. A fair bit of news out there today that his company's obviously always been on the agenda for a while, has gone into administration, but a scathing report came back from the administrators saying that he's basically used this as his personal bank account. He's run it into the ground and he's facing criminal charges.
Well, it's an absolute disgrace, and it shouldn't be news to anybody. I mean, people like Hedley Thomas of the Australian have been investigating Clive Palmer for years. This should not come as a surprise. This is as big a scandal in Australian financial history as what happened with the Bond Group or Christopher Skase. I mean, this, the fact that more than $200 million can be siphoned off from that company to go to his own personal projects is unbelievable. Where has ASIC been? I mean, look, I know we're regulated by ASIC. You've got to be a little bit careful here, but look, they are absolutely asleep on the...
So that's a public company. So that being a public company...
Well, they regulate all companies.
Yeah, exactly. Right? But that company would have, extreme, or should have, a serious amount of auditing done on it. How are they justifying getting that money out?
Well, I don't know.
That's what you understand.
That's what you can't understand. This has been going on for years. It's not just happened the last few months. Read the administrator's report. This has been going back since at least 2012, in some cases 2011. So where has the corporate regulator, ASIC, been? It's not as though there weren't signs. It's not as though you listen to some of the people who know Clive Palmer. You listen to, say, some of the people involved in Coolum, particularly the people who own those apartments that he sort of haven't been able to use them. I mean, look, the guy is a national disgrace, and ASIC is guilty. The ABC is as bad because it promoted him. Tony Jones and all the other people on Late Line.
He was good content for them at the time.
He was good content, but where have the Australian media been? I mean, it is really a disappointing story, and corporate Australia, and I think a lot of people should be hanging.
What does it mean for his role as member of Fairfax? Does that become untenable, or obviously he'll hang on?
Where's the call for him to resign?
Yeah.
I mean, look, there's no one saying a thing about it, right? This guy should be touched. He should be out of there. ASIC needs to go after him, should to commit the money, and the public broadcaster needs to stop giving him airtime. And apparently he's on Q&A again next week.
Crazy.
I mean, just crazy stuff. So they need to take a bit of personal responsibility for this. I think we just go too soft on these guys.
You heard it right here from Paul Rickard. Clive Palmer should resign right now. Moving on, next topic. Let's talk about something much more exciting. Blackmores, Bellamy's and the banks. And when I say exciting, a couple of these stocks have been, all these stocks have been in for a tough ride recently. Let's talk about these Chinese consumer-led stocks. Bellamy's and Blackmores. There was some restrictions from the government on regards to getting their product into China, which has had a negative impact on their share price. How serious are these restrictions, and what do you think it means for these companies medium term?
If you listen to what the companies say, they don't seem to think it's too big a deal.
Yeah.
So you've always got to be a bit careful. I mean, you've got to remember that
both these stocks have been darlings of the market.
They have been darlings of the market, and that's what happens with high growth, high PE stocks. It only takes just a little bit of news, and sentiment can turn quickly. So there's some huge profits people have made on Blackmores and Bellamy's and other stocks.
A2 Milk.
A2 Milk, exactly the same. So if you're getting in now, you've got to bear in mind you are paying a big price. I think China's always a bit tricky. I'm no China expert. I've seen what the companies have to say. They don't seem to be too concerned about it. I think we're just seeing a big, bit of nervous profit taking, and this will probably blow over. But
Apparently, there's a good list and a bad list for the imports that they want to restrict as well. And from what I hear, Bellamy's and Blackmores are on the good list as opposed to that bad list. But yeah, they're just working out a way to try to regulate their economy more than what they've been doing.
Yeah, I guess, look, they don't have their own product themselves. So I guess that if you think that these companies have got good long-term growth potentials, this may be a bit of a buying opportunity.
Yeah.
But I just caution...
The other concern for some of those dairy companies is whether or not the Chinese agricultural industry will take off, which then would have an impact on them, wouldn't it?
Yeah, but I mean, we know it can't. I mean, I think that's the reality. So that's why they're not too concerned. I think there may be a bit of an opportunity for...
So you call them a hold at the moment?
Look, I'd probably say they're probably more back in buy territory. I think you've got to use things like this, but I do caution that China, look, no one ever quite knows what's going on in China. And there are people know a lot more about this than I do, but what the companies have said is they don't seem too concerned about it, and I think you probably go with that view at the moment.
The banks are getting absolutely bashed at the moment from left, right and centre in terms of things like capital requirements to calls for inquiries from the opposition to financial planning scandals. They had a good run yesterday. Are the banks a buy?
Well, they had a good run. I mean, I think they're in buy territory. We said that, we've been saying that for a little while. I mean, my only caution the banks is that there is just so much negativity around, and you've got to see a couple of things happen. Now, you've got to remember it's not just Australian banks that are out of favour here, right? So in Europe, the StockX 600, which is European banks, is down by about 21-22% year to date. In America, the S&P Financials Index, although it's had a good rally overnight, is the weakest performing sector in the US market. So the leads from offshore are all negative.
Is that on concerns over commodity prices and exposure banks will have?
Look, three things driving it. Concerns about world growth, obviously, and the IMF downgraded forecasts again. No one seemed to care about the IMF.
Banks will have bad debts, which will hurt their bottom line.
Concern about the impact of commodity prices, potential exposures to oil and other companies, and where there might be some blowout in exposures that occurs as a result of that. And thirdly, negative interest rates, which is a big negative for banks who are trying to make a margin, right? So put all those three things together. Financials globally have been the weakest sector this year. So that's the lead coming from offshore. Then you throw in the normal Australian flavours, credit provisioning, the property market's going to fall over, all the usual
provisions for bad and doubtful debts.
So I think if the offshore lead starts to become positive, Australian banks can recover. So I'd probably be looking closer, almost be following what's going on offshore. I think CBA touched below its issue price for its last rights issue at $70.50 on Monday. It was probably in buy zone there. We're going to see a rally again today. I think, I don't think there's any hurry, but I think there are going to be some opportunities to look to take a little more exposure to your bank stock.
Okay.
Your banking.
Moving on, last topic for the day. The budget coming up on May 3. Super changes are obviously on the table. You've written some good pieces on this. You were excited by some news that came out from a few of the financial institutions yesterday. Talk us through what we need to be aware of.
Yeah, just worth recapping this, Marty, because we have covered this extensively on Switzer Daily.
Yep.
3 occasions.
But it's important to get that message out there.
What we think is going to happen. But I said, as you said, I got we're on a couple of big dealer group sort of newsletters, and I got one last night, an interesting email from one of the biggest dealers group telling their advisors to go and talk to their clients in the next 2.5 weeks about likely changes in the budgets. And change number 1, which is the abolition of transition to retirement pensions. So this won't be a prospective change, it won't be a retrospective change, but would be to cut it out. And so if you are in that age group between 56 and 65 and thinking about starting a transition to retirement pension, then you may want to do it before the 3rd of May.
Yeah. And for 90% of people, it makes sense.
For 90% of people, the only people it doesn't make any sense for is if you're under 60 and you have a very high, what we call a concessional component of your super payout, and your advisor or your accountant can help you work that out. But for 90% of people, it will make sense. It's largely just a tax arbitrage. If that was to be abolished, then the change would probably be made on the 3rd of May. Wouldn't affect any existing transition retirement pensions, but they'd probably say after this time, 7:30 p.m. at that night, we're no longer going to do it. Now, it's not as lay down misère, but certainly where there's smoke, there's fire. And when you see one of the big financial planning groups come out to its advisors and say,
there could be
hey,
leaks.
You really should be talking to your clients the next 2.5 weeks, you start to think it's got a bit of legs. The other one, of course, is changing the caps. Not much you can do about that, but if you were thinking...
proposed to come down to sort of 20,000?
Maybe 20,000. Look, the bigger risk there if they change the non-concessional cap. So if you were thinking about making a big one-off contribution to super, again, you may want to do that before the 3rd of May.
So what that would mean is you could actually put less money into super if they change the caps on a non-concessional basis.
Yeah. Certainly before the 30th of June, so that's the other thing. And thirdly, I think this will happen, Division 293 tax, which is the sort of the higher tax on contributions, which effectively takes the tax rate up to 30%. I think that threshold will be reduced from 300,000 probably to 180,000. That I think is the most likely change. But look, if you are worried about a transition retirement pension and you are thinking about it, I'd say do it before the 3rd of May and don't leave it in the chances of the politicians in Canberra.
Some excellent advice there. That's all we've got time for. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money.